Hi, welcome. My name is Jonas Thulin. I'm head of asset management here at Erik Penser Bank, and I will try to make this even more briefly than before. Just to show you on 3 slides where we stand in the markets, given that we have a very tough period behind us. We took our necks out a week ago, talking about the Fed will claim that, and then come out and pronounce that they're not going to hike as much as being priced into the market. We actually think we were pretty spot on that one, and we were rewarded for about 1 day, and nevertheless had to give it all back in the following couple of days. This week we are sticking to our positions, given the fact that we think that theme is still correct, and part of that theme is that we believe that CPI peaked in March. This is an old forecast that we made, but we think it's going to be validated and proven right in the instance of falling lower headline growth numbers on a year-on-year basis. I'll show you here just 2-year break-evens with a peak in March. Now, the mirror reflection of this move has obviously been a curve steepening in the US. We think we should be more rewarded in the short end. We like to see the fact that people are adding flows to buy the short end in the US. We have not done that, so we were sticking to the 210 steepener, unhedged in dollars. Obviously being rewarded also in the long end, but we think the short end will should start to drive this even further on as we move forward. And it's quite interesting to see that we have dropped almost, not really, but maybe say 85 basis points lower in break-evens since the peak was in March. So I think it's a pretty interesting move that we can start to see in inflation. And if anything, you can almost see that half of the war premium, whatever you can call it, is pretty much gone in the market. Now we should also take notice of the fact that the geopolitical risk has been, first of all, almost I think about 66 or 70% of it is gone or lowered from the market's point of view from geopolitical risk in regards to the war in Ukraine. So it all sort of fits together from that perspective. We also see that people are spending less money from the credit cards on US gas and petrol stations. Obviously that is to do with the Biden reform agenda and everything, so it's nothing, no news there really. But it's pretty interesting to see that the policy is working. So this is the first out of 3 pictures. We see peak CPI. And will we come back to a transitory environment? I don't know. We have 9 more. We had 10 speeches this week. 1 is already done by Bostic, so we have 9 more speeches come out this week from Fed members. If you look at break-evens and how the way the curve has acted by not shifting inflation into the 5, 10, and 20 year, the curve has completely plummeted. So from that point of view, the market has never really doubted the transitory language. But that is more or less not really important in the sense of an equity market, which is much more hung up on inflation. Why do you think this week's CPI now will be quite pivotal? Now, on the back of all this, we think that the big driving forces, or driving force in the US equities now is obviously financial conditions. Now here you can see the R2, i.e. the direction and magnitude of explanatory power between financial conditions that we see daily basis and the equity market. And for the last week we moved up from about 70 percentage points to almost 90. When this one is falling off a little bit in statistics, we have growth picking up the slack. So it's really a fight between economic growth and financial conditions on who's going to dictate the equity market. It's quite interesting to see that financial conditions are this dominant. Now, there's been a little bit of worsening in financial conditions, but that's actually a lot down to the dollar effect. We have utilized that by having full-on open currency exposures in our books, which has been sort of a good cushion to fall back on in these days. We are obviously not satisfied with the performance in our global equity shares, but still to play around and use volatility, dollar here is really important. I stumbled into volatility there because we're actually doing something in that area as we're speaking, because what if we're wrong that we're going to see the same reaction we saw last week? You might get the CPI print right as we did with the Fed, and then it's all over in 1 day. So we're actually increasing a hedge, and then we are actually moving into the vol space again. So why are we then still at all constructive on the equity market? Why haven't we just sold off everything and walked away? Well, the basic reason is that if you look at this left hand, this is what we use to time the the recovery from the pandemic, and also the 9th of March recovery in the equity market. Now we can actually track the downside in the equity market. So why on earth did we do more of that? Well, what we did is that we shifted the entire portfolio even more into dollar. So that means that for us, we don't see new troughs or new lows actually in the equity market. The dollar stock is actually providing a great cushion there for us. Now on top of that, when we look at the most recent events after the Fed message, is that we can see US spreads coming lower, i.e. secured, unsecured interbank loans is behaving a lot more less risky. We can look at the dollar liquidity through the currency basis, the alpha component, which is also showing more ample dollar liquidity. We can look at the vol curve and also the euro dollar vol, and they're all transmitting the lower risk, a bit more constructivism in terms of the equity market, which is quite interesting to see. If this signal is to be proven right, I mean, we hope so. We think the trigger point could be this week's CPI. We are less inclined to walk into this without, with less hedge than we had last week in terms of the Fed, because we also saw what happened there. It was great for one day, and then we had to give it all back. So we're actually increasing a small layer of hedge going into this. But this is obviously quite important for us that at least we see the big capital markets out there, i.e. rates, currencies, etc., are moving into a little bit more calmer waters. And hopefully equity markets should be able to follow suit. But then again, and it's really worth pointing again, we're speaking about global equities, especially where we are positioned our discussion mandates, i.e. North and South America, and we've done it in a completely unhedged manner in order to utilize the dollar stock as a safety measure, which is why we can keep those exposures actually. So with those quick comments, peak inflation, financial conditions is number one, and it's actually looking a bit more favorable for equities going forward. Obviously, the big focus for us is CPI on Wednesday in the US. And do we dare to sort of bet will be a happy dandy kind of reprint? Not really, which is why we're increasing the hedge by exposing ourselves a bit more on vol. Which really hasn't taken off that much as per yet. So we keep you posted on all this, and we will be one more or further quick brief update in a week's time. But with those words, we thank you so much for your attention, and I'll see you in a week.